Right, thank you very much, Richard. I'm not sure if you all heard me earlier, but as well as Head of Personal Finance at Interactive Investor, I'm also an investing columnist for the Financial Times, and I might be sharing some of the insights from my columns in this presentation. So, first of all, it's maths, not magic. I think the first rule to talk about investment is talk about educating younger family members in the importance of maintaining their finances and investing for their futures. But you might as well remind yourself as you do that. There are three things that I think are important. One is to understand percentage charging on your investments. Now, earlier this year, Interactive Investor did an opinion poll of the average consumers, and we asked them to calculate a 0.5% charge on an investment of £50,000, and just half of them could correctly give us the answer that it is £250 a year. So just shows how wide the education gap is on this. Second thing is compound interest. An extra £25 or £50 a month can really add up. Here I'm taking a lesson from Bobby Seagull, who is a celebrity mathematician. He personally says he invests 20% of his income, so he puts 10% into his pension, and he does another 10% on top of that because he really understands how important it is to get things away early. And the other really neat little rule I like in the maths arena is the rule of 72, which is a simple way to determine how long an investment will take to double given a fixed annual rate of interest. So you divide 72 by the annual rate of return to get the answer. So we're all about knowing your numbers, and this comes with an emphasis on the your. Most people don't know what their investment goal is. Our research, our Great British Retirement Survey, which was a survey of 10,000 people in the UK, found that knowledge of retirement income appeared shaky. And 57% of those yet to retire admitted having no idea or only a vague idea of what their household income would be. So ask, how much money do you need to stop working? How much money do you need to leave a sufficient sum to your family or to pay for long-term care? There's all sorts of goals that we're aiming for, and we need to know what that figure is. We also found in our survey that people just don't talk about money. So I suggested we could find out about what our closest friends and family members are aiming for. It could be a good conversation starter. It may even help with your own goals. A quarter of the people who we asked in our survey said they expected to have a household income of between 20,000 and 29,000, or just close to 30. So what's the figure? The lump sum that's needed to generate that kind of income. And here I'm not taking into account state pension. So that lump sum needed on a sort of conservative 3% income estimate, so I like to be conservative about income and retirement, would be £350,000 to £500,000 for an individual. So therefore, can you find an extra £50 a month, and it could be worth it? We all need to understand in the bottom table here, we have how much money is actually being paid into pensions. Here we have 8% is the figure for auto-enrolment in the country, and we show it at different growth rates, what it would be on £20,000 qualifying earnings, starting investing from 22 up to 67. If you put in an extra £25 a month over that period, you could have you could have up to 90,000 extra in retirement, and an extra £50 a month could amount to an extra £177,000 in retirement. These are powerful messages. But don't be Jack. I think it's time to change the well-known nursery rhyme to this. Jill went up the hill to fetch an early retirement, but Jack started later, so the cost was much greater, and he saved all the way till the end. So Jack here is smiling in our picture here, but I think he really shouldn't be, because by waiting 20 years to invest, he ends up with almost £100,000 less than Jill. Not something to feel very happy about. Cut your charges. It is the one thing that we can control as investors, and it's very easy to say, oh, it's just 0.3% more expensive, it's nothing. But that eats into your wealth faster than you would think. And the charts here show how a higher return can sort of power up that difference and make it a really much bigger one over time. So if you're getting great returns but you're paying more for them, the difference could be greater. There's absolutely nothing wrong with paying a premium for a fund or investment trust, providing its performance beats that of rival options that have cheaper charges attached. And I also draw your attention to some research in 2018, actually, which was by Fitz Partners. So they looked at DIY investors investing in retail funds in the UK, and they found that 34% of people were still invested in old-style, expensive, commission-paying fund share classes. So if you have investments in an open-ended fund, do check if you could move to a cheaper fund share class. Winter is always coming, and it's actually here now. But in the terms of investments, I think we should always think about what our motivations or what our emotions are when we feel like things are getting a bit frosty. Cash is the ultimate safe haven. It can be a terrible long-term investment. And the key challenge is to fine-tune how much cash you need, either for rainy day spending or as a buffer when you're drawing income. And then after that, cash in the context of your investment portfolio. Here are my 3 top reasons for holding cash. 1, if you can't quantify investments at sensible prices, because no investor wants to buy when investments look expensive. 2, as an opportunity fund, if you don't have the cash war chest, you won't be able to fill your boots, it's a horrible phrase, with bargains when the market falls. And then 3rd and finally, as a haven when you are feeling nervous. You can't lose money overnight in cash. Stocks and shares always have that downside risk. And the other important thing to think about cash is so many investment funds actually have cash holdings within them. So you need to drill down into that, into your holdings, and you might actually be holding more cash than you think. Every year, we receive a powerful reminder that equities or shares are far more likely to produce decent returns than cash deposits or lending to governments, which is also prone to inflation. This is the latest Barclays Equity Gilt study, and it shows that since 1899, it goes back that far, British stocks have returned 4.9% a year in real terms, compared to 1.3% for gilts, the government loans, and 0.7% for cash. And over the last decade, cash returns were negative, minus 2.5%. Now, in the context of this, you do need to take the appropriate amount of risk for your personal appetite and your circumstances. But if you have a long time horizon, and many of us, even if we're in retirement, still have a long time horizon for investing of 5 or 10 years or 20 years or 30 years, even more, you do have time to ride out any short-term swings in the markets, and that means you can think about devoting more of your portfolio to the higher risk assets. Here's all the assets that you could have. This is diversification. This is the picture, the mind-bending picture of all the different types of assets you could have. And the point of this, the colours on this chart, is to show you how investments perform differently at different times in the market cycle. So diversification is mixing a range of stock market investments with other investment types, primarily bonds and commercial property, And this gives your portfolio ample opportunity to grow, whereas at the same time you avoid the serious short-term losses. But I do feel that also investors need to avoid the pitfall of over-diversification, or diversification as it's known, and that occurs if you have too many funds that are similar, or too many investment trusts that are similar, or ETFs, etc. And for example, too many UK equity income. Because while the fund managers may have their own investment philosophies, the risk is that the investor can end up owning most or even all of the companies in the index. You replicate the market, and that's something that you can do much more cheaply through a passive fund such as an index tracker or an exchange traded fund. So here's how we do diversification at Interactive Investor. We've got a set of model portfolios. I highly recommend that you read our methodology on the website. We established the broad mix of asset types and that should be represented in the portfolio in order to maximise the likelihood that it will achieve its stated objective. And that means in the jargon, it's the optimal asset allocation. And we do this through a lot of techie stuff behind the scenes, which I'm not going to go into now, but it's there to read on the site if you'd like to. We've also done the hard work for you in selecting the building blocks that you could use to diversify your portfolio. These Super 60 and ACE 30, which Richard mentioned earlier, do have options in all major asset classes. They have our best picks. And they also have options for different types of investment needs as well, so worth looking at. Use your pensions and ISAs. So many people don't use pensions. The examples, the Q&A examples here are taken from the Financial Mail on Sunday's celebrity interview type column. The one on the far side is a typical one, which is all about pensions. I don't like taking risks. I'm going to buy property and use that as a pension. You see so much of that in the press still these days. The other one, which is rather interesting, I'm not going to read it out, but you can see for yourself, was actually Jenny Eclair, the comedian, being interviewed, and she gave her rather unusual take on pensions, which I quite like. But obviously, use pensions and use your ISAs too. Both have their pros and cons. Pensions give them more generous tax relief up front and can be passed on free of inheritance tax. But unlike pension savings, ISAs are readily available in an emergency, and pensions obviously can't be touched until age 55. ISAs, you can get it out earlier. In the context of pensions, don't be like Barbie. She doesn't look it, but she's just turned 60. And in the 1960s, she started having careers. So since then, she's totted up about 200. Some had high earnings potential and good workplace pensions attached, I assume. But with all of those careers, she's likely to have her pensions all over the place. And actually, she's still got 6 years till state pension age, so she has time to sort it out. She may need to use the government's online pension tracing service to locate any lost pensions, and she may need to think about simplifying and consolidating everything that she has, maybe in a self-invested personal pension, to get a better picture of her finances. Has Barbie's life of lavish spending left a huge dent in her finances, though? We all have financial regrets, but I hear she may have put it all on plastic. Here's some inspiration. Invest like a SIP millionaire. Here's a small amount of Interactive Investor customers, about 2.5% of them, hold £1 million or more in SIPs. The average age is 61. The typical portfolio is powered by funds. Over a third is invested there. And then the rest, significant amount, is in investment trusts, equities, quite a high amount in cash, which I mentioned earlier, and a little bit in exchange traded products as well. They tend to favour Star fund managers, Fundsmith Equity tops the chart there. The top 5 funds are dominated by Vanguard, index tracker funds. Investment trusts, we've got Scottish Mortgage Alliance Trust, etc. in the chart. Among shares, that's interesting. They're all the most in-demand stocks are all dividend payers, which is very important. And we've got, in the exchange-traded products, we've got the iShares Core FTSE 100 one, which is the bestseller. The interesting thing about our SIP millionaires is they're inclined to change their portfolios fairly often. There's quite a significant number, 82% have made an investment in the last 12 months, 45% tweak their portfolio at least once a month, and 23% of them do it at least twice a month. Here's another little story where the lady does a little bit better. But timing the market is often described as a fool's errand because those who buy at the wrong time can end up nursing painful losses. This chart shows the financial crisis when people starting just before. Joe starts just before. Lucky Joanne starts just after. She times her entry into the market perfectly, and she has a very nice, a fairly smooth trajectory all the way till to today. And so this leads me to another lesson, which is the reliable way for an investor to reduce the risk that they enter the market at the disadvantageous time, like Joe, is to drip feed money into an investment on a monthly basis, and that benefits from something known as pound cost averaging. When we invest the same amount on a regular basis, we simply buy more when an investment is cheaper and less when it's more expensive. And that investing regularly also takes the emotion out of investing, which is a behavioural flaw that can prove detrimental to returns if we get it wrong. The power of reinvesting dividends is very, very strong. It makes an enormous difference to the long-term investment growth. The effects of compounding works its magic. And this chart shows the stark difference between the returns from £5,000 invested at the start of January 1986 in the FTSE All-Share and the massively different result from investing dividends rather than taking them. Have an annual spring clean. Financial planners advocate that investors should review their portfolio at least once a year, preferably 2. We all know that every now and then we need a drastic clear out, but we don't know which investments to throw away because we all think, what if that investment that I chose so carefully suddenly comes good next month? And this is where I like to introduce Marie Kondo's principles of decluttering. You have to be honest about each investment. Has it performed well? Would you buy it today? And with funds and investment trusts, consider whether the costs are too high and whether the manager has changed or if potentially they're near to retirement. The relative value of our investments can shift, so what was perfectly diversified a year ago may now need some adjusting. And also it's worth taking a look at your winners, because should you be converting some paper gains into real profits and investing into areas that have been underperforming that could then recover their poise? This is a bit of my mantra this year. Don't be afraid to ask stupid questions about investing. But I think it applies whatever your level, because the world of investment is a minefield of jargon, and I want us to be calling this out. So don't be afraid to ask what may seem like stupid questions. They're mostly, well, largely never are. Also, just a call, we're looking for case studies to help other investors. So if you're interested in being a case study, please complete the questionnaire, which you'll find in the bag which was on your seat, and you can hand them in to me or another member of the II team. We're all wearing badges. So now it's time for a little bit of a break. What time is it? So we'll reconvene at 10 to 7 for the fund manager debate that's going to be hosted by wonderful hosts at BlackRock and is on Europe versus UK. And that will be followed then by Q&A with all the speakers you've heard from on stage. You'll be able to ask your questions at the end. Thank you for listening.